I kind of agree in the sense that the best time to start is yesterday, right? It's not I need to have a certain amount that I go all in. It's a process. It has to be repeatable. It has to be sustainable. You have to do this repeatedly, right? So it's a bit like building a muscle, right?
and not very convincing. Now you say I did better.
I show you my photo of 10 years ago. Yeah, so for part 2 today, we actually have something special, right? We got sponsorship.
Yes.
So we have this pair of Audio-Technica earbuds to give away, wireless, so you can listen to our podcast anywhere on the go without having wires like kind of dangling or style, right?
Not bad, huh?
I know,
bad.
right?
Yeah, that's a good sell. Yeah,
so what you need to do, so not everybody will win this, right? We did not get thousands of sponsorships. What you need to do to win this is share this 2-part series on Instagram, tag us, and include a blurb on what's your most insightful takeaway from all this. We'll judge it. So obviously, if you just say you agree everything Anthony says, good job. I vote for you.
Hey, got 3 votes. We'll clear through Thomas also. Okay, so I thought it was a great plug until you continue to that part. Okay, But anyway, and how to win this? Essentially, you share the podcast on your socials on Instagram and tag us at the Financial Coconut, and then do a short blurb.
Yes.
Right? Don't pick Anthony, pick mine. Right? I'll let you win. Okay, so if you want to win my vote, you pick my point. Right? So do a short blurb of what you learned. Right? And then we will decide. It's not random. We get to decide. Okay.
And don't worry, it's not based on your follower count or how well you know.
It's nothing about that.
It's just the one we like best.
Yeah, the one we like best.
We just have feeling.
Yeah, we have feelings. And must make sure we are able to see it. So I got private status on that. That's why I never win, because I cannot even see that you tag me, right? So you tag us and then do a short blurb, and they will pick our favorite comment and insight, from this 2-parter. Any one part that you want to share. Okay, and shout out to our friends at Audio-Technica. We have been using their equipment since forever, right? So I'm very happy to have them give us earbuds, right, to give away, and many other equipments, right? So thank you, Audio-Technica, for this new set. And we'll continue part 2 on this whole investing thing. Of course, part 2, I want to focus on like actionables, like how do we do it, right? If we have 100,000, how do we start? But I know part 1, we ended off with the whole Warren Buffett has shifted, right? So what is the Buffett methodology now?
So when we look back all the way, like when Buffett first started, he actually was a deep value investor. And just to make it relevant for our Singaporean audience, right? One example of a deep value investment is maybe creative technologies about 5 to 10 years back.
Creative technologies.
Yeah. You all still remember the MP3?
Yeah. I used to be so proud that I have it, Then, oh my God, then no more already.
So there was once whereby they sued Apple for infringing on their patents, right? One of their technology, and they won. So they got paid like millions of dollars. And as a result, in their bank account, there's like, I can't remember the figures, but probably around $70 million, for example. And the company was selling on the market for maybe 40 million. So if I were to buy the entire company today at 40 million, I actually would make money immediately, right? Because the cash on the bank is already 70.
Yeah.
So this is what I call a deep value investment. And it was very prevalent back in Warren Buffett days, like right after the Great Depression. There was a period of time whereby a lot of companies, because investors didn't want to touch the stock market, so a lot of company was selling for below what they have in their bank account. Right, but over time, as the stigma of the Great Depression wanes off, opportunities like this, especially in the United States, are getting lesser and lesser. In Asia, we still have a few, like creative technologies a few years back. Hong Kong, there's quite a lot. But the problem with these kind of companies, right, is like watching paint dry. There's a good reason why they are priced that way. Usually, it's very ugly.
Yeah.
And the way to go about investing in these companies is you don't want to own a big position in one of them. You want to own like dozens, like 30 to 50 positions of this, and then you let them dry. You see which one win, which one lose. But most of the time, for most of these type of deep value investors, the winner will pay for the losers. But that's the deep value investing style. And because Warren Buffett, his capital is huge now, and there's a better way out there, which is to invest in quality compounders, right? Companies with a very long growth runway who are able to keep reinvesting in growing their business, making their business stronger. And in our episode 1, if you haven't watched, go and watch that. When you think about returns, right, it's always total shareholder returns. You want to look at the share price, you want to look at the dividends. And when you're looking at the share price, it is always a function of how well the business is doing, which is why he's gradually shifted to owning much higher quality companies that are not that ugly, right? Deep value is always ugly.
Very ugly one.
Very
Turnaround
ugly.
place, one in a few, right? Most of them don't get to turn around, they just turn down. Yeah. You got a reaction just now? Hong Kong?
No, I mean, I think that's the problem with a lot of kind of fundamental statement analysis, right? You say, okay, 40 million market cap, 70 million cash.
Yeah.
The assumption is that 40 million moves closer to 70 million because it's liquidation value, right? But you forget that you are a business owner, you own the shares, fine. You don't actually manage the company. So they could invest at 70 million, lose all of it, and then you end up with a $0 company, right? Or you could, especially in Singapore and Hong Kong, have a lot of family holding vehicles, right? That they are not necessarily aligned with external retail or external even institutional investors. Then they don't ever return that money, right? They just hold it, they slowly pay dividends, so they use it to invest in side projects. Their capital allocation might not be the best, right?
Which is quite common.
Which is
family of quite common.
Which
Asia
is-
companies very
yeah,
common.
Yeah, I've
especially
seen the
within
capital
this region,
allocation
right?
is not the best.
Capital
Yes, I can agree with
capital
that.
allocation is not to give the greatest shareholder returns.
Yes, but it's not as strategic. I feel like a lot of their capital allocation is not as strategic, even when they allocate capital, because at some level, the main business have reached terminal growth,
Yes.
right? That means it's already balloon. How many more store can you have, right? Let's say. So then you start to acquire side brands, right? Or you start to do other things, right? But are there synergies? If there are no synergies, then you grow laterally from your manpower, right? Then you have to manage multiple brands at the same time. So there's a lot of these kind of things that I feel allocation-wise is really not as great, right? I feel like that's my take.
Yeah, so you don't necessarily always close the gap, right? The average market tells you you'll close the gap, your multiples will rise, you will be valued like that, and you make that return, right? But if you have a management that doesn't align with it, that will not return you that cash as a shareholder, what's the point? So deep value maybe still works, but you really need to be very careful of that individual company's context to see whether it works.
Fair. Okay, great. So no brands, don't cancel us. Okay, we will we will pick it all out. But yes, okay. So part two. In part two, I want to have a little bit more context around this, right? So for some reason, there's this 100,000 thing going around. Like everyone is talking about 100,000. So I'm going to talk about it also, right? So what's your take? Like if you start with 100,000, like must you start with 100,000, or like why is this 100,000 benchmark such a thing, like in your head?
I think it probably feels more empowering that, especially if you start from nothing, then when you hit your first 100K, then you'll be like, wow, sure. But the only real
I know that
benefit...
feeling. Yeah, it's quite shook. But I don't get why it's so arbitrary. Like it has to be 100,000.
It's a nice round number, ma.
Yeah.
You 50, 100, then a million maybe a bit too fast, so you go 500.
Yeah, that's right. Yeah. Okay, fair.
I can foresee people on TikTok saying like 100K, why so little?
Yeah,
that kind of stuff.
I was going to say that.
Like why aim so small?
Yeah. But TikTok people must wake up. So please continue.
But when it comes to investing, I think it's best not to start with a huge amount because no matter how well you read, how well you learn, you will have to pay school fees. No matter how high your IQ is, the market will hand your ass on a plate back to you. And it's always better to start young, start with a small capital base. Then, your school fees won't be that expensive.
What is a scenario that the market hand it back to you?
I think like over the last year, not just with retail investors. So I was speaking with a few fund managers and they mentioned, when they go to sleep, a lot of them are actually wearing mouth guard because they are chewing their teeth. And it's until like their molar will start cracking. So that was how much stress investing could give a person, especially if they are investing large amount comparatively to their net worth.
Yeah.
Right. So when it comes to investing, we never know when the market will go south. And sometimes it might not be because your analysis is wrong. You might be correct, but the market is irrational, right, in the short run. And so when they disagree with you, no matter how smart we think we are or how emotionless we think we are, when we see our net worth dive bomb like this, there's going to be a lot of stress. But as you invest over time with a smaller capital base, you slowly start to build it up. You will get seasoned. And this kind of crashes will give you lesser and lesser stress over time as you slowly start to ease into the amount.
So that means 100,000 does not matter. You can start anytime.
Yeah, I think you definitely can start anytime. But
Is there an
100,000,
advantage?
there's one advantage. You get qualified for... I don't know whether you want to censor that one out. But when you're at
A lot of
IBKR Pro,
brands, yes.
your idle cash will get like maybe 4% interest, right? Higher than all the GXS and all that
Above
whatnot.
10,000 and in USD.
Above, yes, correct. Yeah, then you get a very nice return just for putting cash there, for example. I mean, so that's the main benefit of above 100K, I guess.
Okay, fair.
I kind of agree in the sense that the best time to start is yesterday, right? It's not I need to have a certain amount that I go all in. But it's not I got 100K now, I'm going to jump one time school one. I make money, I live off it for the rest of my life, right? It's a process. It has to be repeatable. It has to be sustainable. You have to do this repeatedly, right? So I hiding my belly, but it's a bit like building a muscle. Right? And
not very convincing. Now you say I think a bit better.
I show you my photo of 10 years ago.
Okay. Let's hit the gym together. Yes.
But it's about like putting the reps in, right? Being able to keep doing. So you should always start. Right? And then you repeat that process, you learn. And then by the time you get to a sizable amount of capital, then you are a bit more confident. Because sometimes you don't build conviction just by Warren Buffett did this, therefore I did this. Thomas said this, therefore I can do this. Right?
Yeah, it's quite common.
You can get conviction from other people, but it's a lot of getting conviction and saying that it works is I've done it myself. I know it worked before. I think logically, theoretically, it can continue working this way. Therefore, I'll do it. So I think you don't need the 100K to start. You can start. And we talked about this in part 1 as well, property versus stocks, right? You can start with small amounts. You can start with fractional shares. And nowadays fractional shares. And it's so cheap now. Last time I remember buying Singapore stock like $30. Yeah. One transaction, $30.
Yeah.
Buy $30, sell $30. If I put $1,000 in, right, in a penny stock, I need to make 6% just to cover transaction costs. It doesn't work, right? But now it's like $1.30 if you go to some of the brokerages. So why not?
It's already so cheap.
Yeah.
But I never start with the Singapore market. I started with the US market straight away.
I started with Singapore market because it was what I knew.
Yeah.
I think one thing to be conscious about, despite all this jazz about repeating and all that, is that the amount changes you. And I experienced this not at the 100K level, but at multiples of that, where one day I woke up, I realized, hey shit, this is a decently sized amount. I need to start thinking about protecting it a bit more than growing it. Right? So my goals in that sense shifted because what I wanted with this money kind of shifted. And then that also changed my style a little bit.
Yeah.
So what you learned got you here is not necessarily what gets you there. You know, I'm learning all these books. I read too much. Right? But I think that is generally where. So again, it's about being flexible, knowing what you want, knowing what you want to achieve, and then you choose the strategy that fits that goal.
Yeah. We'll get there. Yeah. So I agree, and I will challenge a lot of people that say you must use the same method throughout. I think it's a bit interesting, but we can talk about that slightly later. Okay. So then the next question is people always ask, right? So I got 100,000. I want to start. Should I go lump sum or should I DCA? Or do you think both also don't? Right, bit by bit, slowly try.
For me, I definitely think the person should DCA lah, because you don't want to jump into the pool straight away, right? Get your feet wet first. So when it comes to investing, the rule of thumb is that time in market matters more than timing the market, which is why I think they probably come from that point whereby you just invest in one shot, right? I haven't watched the video, so I'm not sure. But when it comes to thinking about investing, there's always that human element. So there is always that fear and all that whatnot. And when we are first starting out, when we are first getting acquainted with the movement of the stock market, a lot of us, when we first start out, we are going to check the stock prices every day.
Oh my God.
We are going to check.
Every day.
In fact, maybe every 5 minutes.
Every moment I'm logging in. Right. That was,
you keep sending the thumbprints,
keep sending the thumbprint. Now no more. So you will get past it, you get numb from it.
Yeah, you will get over it. That's why I think it's important to start small and slowly ease in. You want to pay attention to how you are feeling, because it's not just what we think, but it's also how we feel. Because when it comes to investing, if the stomach is not strong enough, you may have the best plan in the world, but if you can't execute it, then you are just going to have another very expensive lesson.
Yeah.
So I feel even if you think the market is extremely undervalued now, or whatever it is, if you are new, I think you should slowly wet your feet and then go in the market bit by bit.
Actually, whatever you just said, right, it is an endless battle, between like what is mathematically correct and what is executional reality, right? So mathematically correct, yes, start yesterday or start today, start now, start everything, go in, straight away. Mathematically is superior compared to if you slowly dip, right? I think that's fair. Yeah. But executional wise, right, all these are realities because you're executing your own money, you keep checking, you cannot sleep, you do all those weird things, right? No matter how many times other people tell you don't do it, right, you have to build up that muscle. So from the executional front, I understand what you're saying.
Yeah, but
you disagree.
To a certain extent, it depends, right? It depends.
Okay, I love it depends. Yes.
So, I think people will always say lump sum, and this is kind of the bias of somebody who has done this a while, is because back-tested, lump sum beats DCA. because timing the market versus timing the market, or that kind of axiomatic things that people like to throw around. But I think backtested, it gives higher returns. You want higher returns, why don't you do it? The mental bit maybe makes sense. I agree. But, I would say at the end of the day, you are who you are. Just because you stress and you check every 2 minutes, my 100K became 99, became 98. Actually, it doesn't even move that fast, right? And here we're talking about ETFs, S&P or Nasdaq 100 or whatever. It doesn't move that quickly, So what is that fear? But if that really makes you lose confidence in yourself, then you need to go back to part 1 and listen about mindset, right? Because
Retarik this whole thing.
That is already the wrong beginning. And I mean, even if you feel stressed, you feel whatever, as long as you don't sell, because you kind of trust the process because we told you so, then problem solved. So you can do all these behavioral things to control your own actions. Just because you feel stressed, just because you worry a bit more about it, isn't necessarily a bad thing. And in some circumstances, it can be a good thing because it forces you to revisit why you did it.
Okay, so then today we set the context. With 100,000, I want to start investing in single stocks. On some level, I think when people invest in single stocks, fundamentally they are saying that they want to beat the market, right? Can we assume that? No. So that's not the idea.
Okay, so I think most people who just want to scratch the itch, they will have a mixture of strategies. So like maybe 80% of their portfolio is in ETFs, indexes. Then 20% they scratch the itch.
That's the real portfolio,
satellite.
right? The core satellite
They
idea.
know themselves well. They know when it comes to drawdown, they will start to doubt themselves. If you lose 300K, you start to think like, oh shit, I just lost a HDB. So when it comes to active investing, to be honest, I don't check the prices that frequently. Also, it's probably like 4 to 6 weeks-ish. I track the fundamentals more often, but it largely lies with my investing style also. So when I'm investing, I'm very clear, like I'm investing to make my life better, not to create more work for myself, which is why I will avoid micro caps or companies that are highly leveraged, anything that will give me heart attack. So things don't change on a day-to-day or week-to-week basis so much. A lot of times, just by following their latest product updates or even just their quarterly earnings is good enough.
Okay.
Yeah, and so that's how usually I approach it. I also try not to open up the brokerage account that much, because I know I might be tempted to do something stupid if I keep logging in and look at the price.
The apps are learning from the consumer apps. They are learning, right? So all the little things, because I used to run a small tech company, right? So I kind of know what they are doing. It's like, hey, this one already proven, right? They gamify, right? And then all the randomness, all that, right? Is all a part of the learning to increase your transaction, which is beneficial for them, not necessarily beneficial
to
for
increase
you.
your engagement and the touch points.
Engagement, touch points. Hopefully you can do more transactions.
learning
right?
also.
You're learning, very bad. You're learning all the bad things. So the consensus is not everybody is out there to beat the market when they pick single stocks. Because that's my assumption, if you go in with 100,000 and you want to pick single stocks, then your benchmark is the index, right? Because if you don't beat the index, then why are you picking single stocks?
Okay, so I think that's the thing, right? And we can talk about very many different goals. So for example, I don't need the highest absolute return.
Yeah.
I need the highest risk-adjusted return, right? Because I want that I'm closer to retirement, I want stability. Or I know that my personal case is I can save X amount per month. I can invest it. I just need a hurdle rate of 7%. 10 years time, I'll get to where I need to be. So what I want to do when I invest is I don't care what the market does. I don't need to beat the market, but I want that 7%. So if cash gives me 5% now, great. I'm going to hold cash because that can be a big part of it and just find 9% somewhere. Right, and then it averages out. I get my 7%. I'm happy. So in a sense, I'm a bit like a defined benefit pension plan.
Okay,
right.
Okay.
So I think it goes
pension
back.
Plan.
Yeah, pension plan for myself lah.
Yeah.
So in a sense, it goes back to what you want to achieve out of this, and then you choose your strategies and you choose what you do to fit that. Because if you want the highest absolute return, it's very easy. You lever up, you buy the riskiest thing, and you take I will put Pt.2. And then do it lah. Right? You borrow money, you buy 0 DT options, and for earnings the next day, you can make money. You look at a very different parameters from what we would look at, for example. So, I think you need to know what you want to achieve out of this, and then you start choosing your strategies to fit that approach.
Okay.
I love that point because a lot of times people talk about beating the market, but not many people talk about, how much risk are you incurring. If you settle for lower returns, but your risk is drastically lower, then that might make sense for a lot of people as well.
So then on some level, you believe that some single stock picking can be safer than the whole index itself?
I think if the person know what they're doing, I think it's possible.
Okay, great. We set the basis, right? 100,000, we're going to pick single stocks, right? Maybe not beat the market, but at least be in the ballpark of like 7-8% at least, then go further from there, right?
Okay.
So if someone wants to do that, how will you teach the person to start?
First of all is that you must always think in terms of 5 to 10 years time horizon. It doesn't matter if you beat the market 1 to 2 or 3 years or you underperform 1, 2, 3 years. Ultimately, it is the long run that matters because it's not possible for someone to beat the market year after year. Even for Warren Buffett, right? One of the best investment results in the entire world, he don't beat the market every single year. There are going to be years whereby he underperformed. There are going to be years whereby he overperformed. And what's important for someone starting out is first, you must make sure you are adequately diversified because especially when it comes to 100,000, if you're investing only in 4 to 5 companies, if one of them go wrong, you're going to be heavily
20%
punished.
of your overall capital, yes.
You're going to be heavily punished, right? So you want to be adequately diversified. And
What is considered adequate diversified?
I would think it's anywhere between 10 to 20 stocks because when it comes to diversification, right, the benefit of diversification, there was a study done on this, like it drastically drops after 30 companies. But by owning between 10 to 20, and the reason why I don't say up to 30 because most people have a
You
full-time
cannot
job.
handle 30, yeah. It's very hard, right? Keep up 30 companies is so difficult. Yeah.
So we always must bear in mind, every company we have, right, we must go through the financial result. We need to go through the earnings call, so on and so forth. So to enjoy the benefits of diversification and also at the same time, you know your companies within the amount of time you have. I think 10 to 20 is a sweet spot for most people.
I agree.
Then the next thing you want to do is you must make sure you go on and study these companies because like there's a whole range of checklists we need to check off when we are analyzing companies. But if I were to boil it down to just one question, is why does this company deserve to be bigger 10 years from today? Because that answers many things. That answers like why people will not disrupt them. What are their competitive advantages that will allow them to earn excess profits over its competitors? And ultimately, when you're owning a company, you want to make sure that fundamentally the share price is going to track the performance of how the business do over time. And if you're able to answer with a pretty good certainty that this company will be around 10 years from today and they will be stronger, they will be bigger, then chances of you earning excess return is probably pretty good.
Fair. I think that's a good assumption. Okay, but I want to ask one question on portfolio allocation. Let's say we assume 20 companies, right? And I got 100,000. Does it mean that every company that I go into is 5,000? Is that how you would think about it?
I would think about it in terms of cost basis. So that is how I would allocate.
What does that mean?
Meaning like if I want to have, let's say, 20 positions, right? Then I'm just going to allocate on a cost basis 5% to each of them.
Okay. So you will not factor like bigger
which one
company,
conviction,
none of those things.
Not so much about, I mean, I would play around between that 1 to 5%, but I'm very reluctant to go beyond 5 or 10% on a cost basis for each position. I used to be a lot more aggressive when I was younger. But when it comes to investing, it's important to diversify adequately because ultimately, if you're in for the long run, right, capital preservation is important. I think we are going to talk about circle of competence later on, but the most dangerous thing when it comes to investing is not what we know that we don't know. It's what we think we know, but we actually don't know. Right.
All the assumptions, right? Essentially.
What we think we know, but we don't know. And a lot of times it is this kind of risk that will slap us big in the face. And the only way to go around it is through proper diversification and allocation.
Okay. So in your view, cost basis is the best way to start.
Yes.
Right. So 5% if you're doing 20 companies. Okay, fair. Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. And then you?
I mean, if the goal merely is to 7-8% beat the market, honestly, I'll just put 60, 70, 80% in ETFs.
Okay,
right?
if we move away from the
No,
ETF.
wait, let me finish.
Okay,
right?
okay.
That forms the base.
Okay,
right?
okay.
And then the remaining 20%, right, you can hold in cash while you study because you get decent cash rates now. And then you swing for the fences. You really look at things that you have super high conviction in will outperform. It's the next Amazon, it's the Chris Mayer 100 bagger type of companies. You swing for the fences for those because you are less worried about your downside risk. Right? Your downside risk is literally limited to 20%. You can be very, very concentrated in these and then you really study and you just follow 3 companies. Right? It's a bit easier right, on your thesis and your time. And then you really go for it. You take the risk in that 20%. You go crypto, and not Bitcoin. Bitcoin is safe now.
Bitcoin is the beta. There's no more alpha in it.
You go by super small companies or smaller companies that could theoretically grow. You don't go and buy Tesla, because even if they grow from 800 million to 2 trillion, that's 2.5 times. And over 10 years, that's not super great compound annual growth rate. Then you swing for the fences, you go mid cap, $10 billion companies that could become $100 billion or an $1 trillion company in 20 years. And then you swing for the fences there, and that is where you make outsized returns. We still go back to fundamentals. I think it's just the approach is different.
Yeah, it's a very different approach, right? So this one is like 20 different companies. I say we just take 20 different companies, 5% each, right? Broadly,
I got 503 companies.
Yeah. So 60% in the ETF, which is the 500 companies, and then maybe like 20% in 3 companies, right?
Yeah.
Okay, and then you go for the highest conviction mid cap play, right?
Yeah.
Okay, so important, we talk about cap. Okay, I think that's a great discussion. So how important is the capitalization of the company? And for simplicity's sake, it means the overall value of this company bought in totality today. So this whole company is worth 500 billion. If you buy every single share today, that is a market cap. 500 billion. So how important is market cap when you're analyzing as a beginner?
If you are investing in micro cap, I think it's under 500 million. I can't remember the exact cutoff.
Just some definitions here and there.
Yeah, it just means it's a small company.
Yeah.
And by the virtue of them being a small company, it means the range of outcome is going to be a lot wider as compared to a Microsoft, right?
Yeah.
Microsoft 5 years from today, it's probably still going to be the operating system we are going to be using, probably. But if you are talking about a much smaller company, they might not be around 5 years from today. And when it comes to investing, even in the US or anything, disclosures for a lot of these micro cap is going to be way lesser than what the big companies is going to have. And so for a lot of micro cap investors, they really do this thing called scatterbutting, meaning like they will really go and track this Instagram page of this company grow how fast, how many users, how many they are gaining on a per day basis.
I know, even Glassdoor, all these are various site things they also pick up as an evaluation structure.
If their product is on sale on Amazon, they'll be tracking how many are sold every single day and all that kind of whatnot, because they are trying to get information advantage over other investors. Because when it comes to micro cap, a lot of this information not exactly transparently to everybody. You have to put in effort, you have to go and dig. I even know people who will track, at the back of the plane got a number, they will track where the CEO is flying to know where they are doing business deal so that they can try and have a better...
I don't want to be friend with your friend. That friend very scary.
Oh, very scary. Very scary.
It's okay, we want to have a private jet.
Yeah, it's okay. Yeah. Maybe next time.
Yeah. So when it comes to investing in very, very small companies, you need a lot more work. And risk is not in movement of share price, but is in the outcomes that could happen for the company or for your investment. And in that sense, the range is a lot wider. So the risk is also higher. So if I'm starting out today, I would start with companies that I'm more familiar with. That doesn't mean that we go and buy brands that we use. Like I use Uniqlo, I go and buy Uniqlo.
We're not going Peter Lynch.
We're not doing that. But it's a good place to start because you understand the product. Then that's where you see whether this company, is it a good investment or not. So that's a pretty good starting point.
So that's micro cap, right? But what about like mid cap? Something like a 10 to 30, 50 billion type of company, which is actually quite a lot in the market, right? And then quite a few of them did perform. By the time your company at 10 billion, right, some structure is there already, right? You may not be the market leader, but there's a product, there's a space, you have a generally quite defined market that you're addressing. And,
you have a story and you go for optionality.
Yeah, you can invest here. There are like more things already by the time you're there. What is your take on that kind of company? Like,
I think when investors are investing in mid-cap or loss-making companies, they're not necessarily bad. But we must understand that for a lot of loss-making companies or smaller companies, there is no...
I love the assumption. 10 billion means loss-making company, which is
true. Can be profitable.
Later you control.
How much is C market cap now?
I think
40.
40. I think.
Around 40. Profitable now.
Profitable now. But for example, C Limited, you can't really find a floor to how low they will be dropping, right? From 300 all the way to like $40, which is less likely in the case of super huge cap. Of course, Meta dropped all the way to $80. But when that happened, the company will be buying back shares aggressively. And even if I'm not allocating additional cash to Meta, for example, I know for sure Mark Zuckerberg will be buying on my behalf. He'll be buying back the shares, he'll be cancelling the shares. And as a result, my ownership, all this will increase proportionately.
So he's not going out there to fight.
Yeah.
So you're very sure he's not fighting?
This one I don't know. I'm actually curious to watch it happen.
I wouldn't want him to go and fight and get injured and all that
Yeah.
shit. No. But yeah.
But when it comes to investing in mid-cap, these companies could potentially give you very high returns. But we must be honest with ourselves as investors. Do I have the stomach for this volatility? And do I have the time and interest in tracking a lot of C's Limited's movement? Because for a lot of my friends investing in C Limited, they will be tracking a lot of things on Google Trends, like how much web traffic is going to the app, how much web traffic is going here, and all that whatnot, to try and gain some insights over other investors. So, I mean, for myself, I do have a few positions in mid-caps like this, but it's not big. Because again, I'm investing to fit my lifestyle and not to create more headache for myself. So when companies like this, they have a bad quarter, in a short run, they fall, I'm quite all right because it is a small position. Most of my positions are anchored in much bigger companies.
Okay.
So you're quasi-indexing lah.
Quasi.
Not really quasi.
I mean, the big boys make up a big part of the
Yeah, that's
index,
why.
right? So, okay, fair. Then what about you? Mid-cap, all those?
I don't really look at market cap, to be
So it's
honest.
not important.
It's less important to me.
Okay.
I get all these points around development and all that. It makes sense.
I get what you're saying.
But I think what I like companies that are well covered. So it's either they are trending on X, not Twitter. So everybody loves covering them. And you get all these stocks in the ZGIS. They come to you in the ether and then you go, interesting company. I go look at it. And the reason why I like this is thinking back about what is my skill. My skill is I'm able to absorb information. I'm able to process information relatively well, and I can come to my own decision over what these things are. And because of that, what I want is I want information flow. I don't want to go and track all these primary indicators. I want people to tell me what these primary indicators are, what their thoughts about it, because that kind of leads to the market and why I disagree. When I disagree, okay, is this mispriced in a pricing in sense? Is there some inefficiency that I think the market is not very correct and I will go into it?
So well covered is more important than
so well covered. There's people talking about it. It's more important than actually having to do all the primary work yourself. It's a bit like doing research, right? Do you do research from the very beginning and try everything, or do you stand on what other people have done for their research and try to build onto that?
Yeah, and based on that, I have an extended question, right? Essentially, what is your take on people just reading someone else's analysis and then making a decision? Because I think for a lot of people that are out there investing, especially when they are still, a bit younger and newer, younger in the investor sense, but there is a general tendency, and that's why all these brokers and banks, they throw out thesis. So it is a thing. People do that. Right? What is your take on new investors doing that?
I think you always have to go back to the source and develop your own opinion first before you even read what other people think, because what they think is going to have a very strong anchor to your thoughts. I had an intern last time. When I asked him about certain things and his answers, were all pretty flaky and all that whatnot. And then that was when I realized, a lot of times when he do research, he only read what other people are writing about. He don't go back to the source document. He don't listen to what the management is saying. And it's a bit like I hear about maybe what other people say about Reggie instead of getting to know Reggie himself.
What they say. You want, you come. Relax. Off camera. Yes.
But when it comes to investing, that's how I feel about it. We always have to go back to the source documents, do our own due diligence before we even consider reading what other people write about it.
And that in itself, the ability and the framework of thought to evaluate primary source documents is also a very, very, very long discussion. What do you look at? How do you think about? What are the parameters? Blah, 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 and which we will not be able to cover today. There's too many things in that, right? So sign up for Thomas's course. Right? I think he has a new course coming out. Maybe we will have a course also, so we'll see how that comes along. But I think the idea is you must gather some sort of a framework of thought around this thing. To simple terms, is like what do you look at? How do you think about this, right? This thing takes time to form. Don't just read other people's analysis. But what is your take? You sound like you have a different take.
I mean, I get it, but I think the fundamental point is two things, right? One is you need to kind of have your first principles, your guiding star as to what you think drives outsized returns over the long run. Whether that's, you go to look at Mabelson as return on invested capital, look at different metrics, whatever, right?
So what is your guiding star then?
I think you want companies that are aligned with shareholders, so they are generally shareholder friendly.
That's why you hate family businesses, right?
I have a lot of money.
A lot of people got a lot of grievances around that.
I was talking to the ESR CFO for work the previous day, and oh my god, the stories that he can tell after the Sabana read thing, it's amazing, and we can do that later. But I think the reality is that you kind of need to know what your North Star is, what is your fundamental belief that drives returns, whether that's the growth investors like, growing revenue, that'll be great. good growing
That
revenue,
is the
good,
North Star, yes,
good
for
unit
them.
economics, they will make money. The expectations investors, like, we want return on invested capital and we want some growth in return on invested capital.
ROIC bigger than WACC or something like that, right?
And,
So
and
everybody got their own
in
things.
the long term, I think that's more towards your approach. You will compound steadily over time and problem solve. So you kind of need to know what vibes with you. And many ways to skin a cat. No one absolute correct way. So once you have that North Star, then I think the fundamental thing is you need to validate what the company is.
Does it meet the North Star?
Does it meet the North Star?
Okay.
And I like secondary sources more than primary sources. And that's why we talked about well-covered companies.
Yeah.
It's because there's always competing viewpoints. So I can develop a view, that's my view,
Based
that is
upon
based on multiple views.
Okay.
And the key is that you are validating your thesis along certain axes that you're optimizing for. The key is not, I must go and do the work and read the financial statements and listen to every single word that has ever been said about this company.
Fair. I mean, that's a fair point. So essentially based on your North Star, right?
Yeah.
What you're going for.
Yes.
Okay. But then what is your North Star? I mean, I just want to ask, like, based on what he was saying, right? So in the same lingua franca, what are the main things that you look at for the company that you're going to buy? Or what is the theory that you hold to?
I think it depends on the business model of the company, right? For example, if I'm investing in a company like Costco, for example, then obviously I wouldn't be looking at their gross margins because the whole value proposition is low prices for the customers. But what I will be tracking closely is perhaps like stuff like revenue per square foot or how much
Membership.
members,
That's their
how
main
much they
business.
churn,
Yeah.
so on and so forth. And I'll be listening very closely to management as to what their future strategies are. The thing about looking at all these metrics is or what my North Star is, the thing is going to be different from company to company.
Okay.
But ultimately, we always want to ask ourselves, why would they earn excess returns over time? Or rather, how are they keeping competitors away?
Okay. Fair. I think there's a lot of things to discuss when it comes to like the framework to evaluate single specific stocks. We definitely cannot cover everything today, but if all of you like it, comment, share, let us know. We will probably do more. Okay? Can do more? Hey, tell Thomas come on the show. It's very difficult one. Can do more?
I try lah.
Okay. Go try. It's very good already. Go try. So you must,
He didn't say no.
Yeah, he didn't
I
say
did
no.
not hear no.
He didn't say no. He said try. So you must comment, share, ask questions, and then from there we will think of more specific things to answer. Okay, so that is great. So we already covered the part about like how do you start, the things that you look out for, the North Star accumulating over the period of time, right? I think the question a lot of people will ask is like, when do I sell? That is a classic question, right? When do I sell? Yeah, maybe you want to talk a little bit about like.
I answer for him. This is change.
Don't like that. But yeah, when you sell?
Maybe I talk about the selling thing. So I mean, there's 3 reasons I would sell. One is if I discovered that I'm wrong, like something.
Like C Limited.
I think
you sound like you sold. I mean, I don't know.
Oh yeah. I mean, I sold last year or something.
Okay.
After they demonstrated that Garina, which is the cash cow, has started to decline. And the whole thesis around C Limited is that it must become number 1 in Southeast Asia for them to become hyper profitable in the future. And that's the game of e-commerce, right? For Amazon or for Mercado Libre or any companies like that, you must be the number 1, right? And for them to do that, they were outspending Lazada, they were outspending GoTo and all that whatnot in the Indonesia market. And that was allowing them to climb up to number 1. When Garina was starting to go downhill because India banned and then COVID reopened, people start to spend more time outdoors. That
Which is
cash
great,
engine,
just saying, don't keep playing games.
Yeah, don't keep playing games.
And that's the dichotomy, right? It's like as an investor, you want people to do that, but actually, don't go and play games.
That's not to say that it is a lousy company or what, but for me, that was my thesis. Garina is going to sustain itself and it's going to power up their e-commerce operations. And when that changed, that thesis was broken for me. And then the second thing that will trigger me to sell is if the company has become egregiously overvalued. So for example, when Cloudflare went to 100 times price to sale, it was ridiculous. For them to grow into that valuation, they need to compound at more than 50% like into the decade or something like that. And when I ask myself, is this going to be reasonable? Is this even reasonable assumption or not? The most aggressive of assumption. If it's not reasonable, then I think it's probably wise to take some money off the table. Generally, if it's a bit overvalued, I'm not.
What is fair value then? Because there's a base assumption there, right? Based on price to sales, there are 100x.
Right.
What is a fair valuation that you are benchmarking
So
on?
when it comes to valuation, there's always a few factors. One is profitability, second is growth rate, and third is how long can they keep doing that.
Yeah.
And when you put in those assumptions in, you try and think about, their their end state, what their margins will be like, or at their end state, for how many years must they grow at that 50%, and then you apply a reasonable terminal multiple to that, and you start to see that the returns still doesn't make sense. Then to me, that is way too overvalued. But if a company is just slightly overvalued, I have a tendency to continue holding, right? Because time is a good friend of excellent businesses.
People that are doing well, you give them a bit more time, right? Companies that are doing well, give them a bit more time.
Yeah, sometimes they will just grow into the valuation. So I'm not a big proponent of exiting once it's overvalued. It's only when they're ridiculous, then I'll start exiting. Or the third reason is if there's a better opportunity out there. And if I don't have excess cash, then that's where I'll rotate some over to a new position. Yeah, so basically these three reasons.
Fair. Oh, still
I mean,
disagree.
thesis change, right?
Yeah,
You agree with me,
I mean,
right?
that's the first one, right? Thesis change, right?
I agree with that.
Okay.
You kind of, and I think that makes sense. I think where we differ is I just put a different weightage on things.
Yeah.
So, I mean, we take the example of C, even though they're not sponsoring us,
Yes.
right? I agree with you. Once Garena started coming down, the flywheel, you see, starts slowly stopping. There was always that flywheel effect. I have cash, I dumped that loss-making business. One day, that loss-making business will be great. I'll be great at gaming. Win. Then that was the super optimal outcome that everybody was hoping for. That's why the share price went that way. And then once that optimal outcome started, failing, your thesis kind of starts shifting a bit, right? Because them not having cash did not necessarily mean that they couldn't still be the number one e-commerce player in Southeast Asia, which was the bigger price. I mean, they started as a gaming company, they pivoted, but that was the big price. And with C capital and all that, they still have a few more optionality to play out. So I didn't actually sell at that stage. I was like, oh, sure, we give them some time, right? They have good management. And actually what I was quite impressed with was they kind of flip a switch, right? They went from I burn cash, market share to I want to be profitable, right? They flipped that switch. The markets want this, and they did it. And that kind of gave me a bit more confidence in them that sure, no, they can still win that price. I'll buy a bit more at a cheaper valuation. I know that I don't have that flywheel, so necessarily I won't win all three things, but I can still win one or two. Right, and my valuation goes based on that possible one or two winnings. Yeah, at this price, can I still get a decent rate of return? The answer is yes. Sure, I can buy more. I don't need to sell. I mean, ideally I sold at the top and buy at the bottom, and I still believe in the thesis. But yeah, sure, I can buy more. I have more capital. And where I actually sold was sure they had done all this and they had shown good management, but the markets, at least up to this earnings, really overran it. And then they started valuing C as if it was going to be a great growth company again, when it clearly wasn't the case. To me, that was when the pricing had kind of overstepped the thesis or what the limit for the company was, or it would have taken a long time to grow into that. Like they were pricing that C sure win. So I was like, okay, you know what, this is a bit too much. I've made a nice 100% of this run up. I'll sell a bit lah. I trim my position, it come back down, we can reevaluate the thesis again. And that's the thing about when we talk about thesis or about companies and what we think about company, it's always changes. Every single new piece of information that comes in should change what you think about a company. I mean, it doesn't have to change. You shouldn't change 180 degrees, right? You shouldn't have one piece of information come in, wow, this company greatest in the world to this company.
Out there, yeah.
But you need to keep adjusting your frame of reference. You need to keep thinking about why that company is doing what it is, what makes it good, what makes you think it can deliver you outsized returns. And then, you keep adjusting that train of thought as new information comes in, as new earnings reports comes in, and things like that.
Okay, fair. How about we talk a little bit about circle competence at the end? Because I think for a lot of people when they're first starting, we've covered quite a few major touch points, but where do you really start, right? And I think circle competence is quite a decent framework to think about. Like, where do you start? Whether is it starting a business, starting investing, all that. I think, on some level, you got to realize that there's a sphere that you understand better than other spheres. So maybe you can share with us what is circle competence.
Right. Well, maybe I'll just give a quick introduction. So a lot of times when investing, we always say we want to invest within our circle of competence. In other words, it just means what we know. And outside that circle of competence is what we don't know. So we want to be very clear about that. So for me, that's pharmaceutical company, 100%. I don't know. Even though the
complex, it takes a few years to understand
returns on invested capital for the industry is great. I will not go in because I don't really understand which is the next pharma company that will produce the winning drug, for example. So I avoid that. But there's also another aspect of circle of competence, which is the part whereby I think I know, but actually I don't know. And that is also equally dangerous. And
but it's hard to...
It's very...
Yeah, I think that one is like, you don't know what you don't know. That part is a bit hard to, prep for it, you know what I mean? Like it's just, you're forever going to get a blind spot until you see that.
It's when the share price drops 50%, then you'll start questioning, do I really know this or not?
Okay.
Then that's where it starts to...
I'm great.
The market is wrong. Everybody is wrong. I know for sure this one can.
And if you did that for Meta or Netflix or Nvidia a year ago, you would have done great, right?
Yes,
So,
yes.
okay,
fair.
the market overswings, right? In the short term, we all agree.
Yeah. So do you believe in a circle of competence in that sense?
Yes. It depends, right? I think circle of competence is not so much knowledge, right? Because knowledge you can build, you can read, you can learn, you can research, whatever. It's skills. Because I think at the end of the day, and this is kind of the fun part about equities, it's kind of a competition, right? You are up against, it's a competition with yourself and your mental beliefs and all of that, but it's also kind of...
So liberal left, huh?
Yeah, an amalgamation of what other people think about different companies and all of that, and that makes up the market. So, you need to kind of know, okay, fine, there's all these people who are going to study these companies very deeply. They'll know more about financial statements, they'll know more about accounting, they know about modeling, they know more about e-commerce because they are in the industry. What is my advantage? Where can I realistically be in a better position than all of these people to make excess returns? And that's why I kind of go back to secondary reports and all of that, because I believe that my competence or my skill, and this is something that I hone in my day job every single bloody day, I'm talking about arguments, is arguing with people.
That's a lawyer, right? Sorry,
right? Is that, I can weigh arguments and I can come up with what I believe is the right mental model and the right way to think about a certain company, right? And that will drive my outside returns.
So it's not industry specific.
It's not industry specific. It's what as a person you are
what am I good at. Okay.
Right? And how you can translate that into getting you better returns.
That's interesting view, because I think a lot of times when we're talking to like ground up type of fundamental investors, people that pick stocks, I rarely hear that view. It's more like primary source information, you must set out your mental frames, you understand all those things. But that's a different view.
I mean, that's not important, but you need to know yourself. You can know everything else, you don't know yourself, you don't know how you react.
Let's be clear, both are equally valid, right?
Yeah.
It's not
No, I don't think it's one or the other.
It's not
you
one
need
or the
both.
other. You need both. Yeah. Fair. Great. Any last things you want to say, based upon like people starting out as an investor?
Maybe just like 2 more things. If you have existing high credit card debt or whatever, clear that one off first.
Oh yes.
Don't invest until you clear that thing
Don't think you
off.
can run beyond that.
20% returns is very difficult to beat that.
Yeah.
So go and clear that. Then make sure your downside is protected. If you don't have emergency cash, go and have that. If you don't have insurance, settle the insurance part. Make sure you don't get disrupted from the stock market, because you never know when the stock market will agree with you. For all you know, it may go down for the next 3 years and you don't want to sell when the company is actually still doing okay. It's just the market not agreeing with you in the short run.
You need to avoid getting knocked out.
Yeah, exactly.
It's true. Yeah, if you don't die, you can come back again.
Yeah.
So in closing, where can people connect with you if they want to join your program and all that stuff?
I think if you want to look for me, you can find me at steadycompounding.com, or if you want to look for me on socials, Instagram or Twitter, that's steadycompound. At Steady Compound.
Fair. If people want to talk to you, I mean, but are there any direct channels?
Not yet.
Okay,
there will be.
Yeah, I know you're
Reach
setting
out,
out
come
your
and
stuff,
plug.
right?
Yeah.
So we will come back to you, and we hope you find these 2 episodes very, very beneficial. And yes, sign up and participate in the giveaway. Okay, share this on your socials. Let us know what is the best snippet that you've gathered from this 2-parter. Okay, share the podcast and the snippet, and then we'll pick lah. Okay, we got 3 votes. Each of us will pick our favorite, and then the person that gets the most vote, then we win.
But when must they share?
When the episode goes out. Okay, so when part 2 goes out, you share within 24 hours. We'll pick somebody. Then we'll let you know. Okay, thank you guys. Bye.
Bye.
Bye.